Another financial ratio is the times interest earned, which indicates how well an entity can sustain debt by measuring its ability to meet interest payments as they become due. Also known as interest coverage ratio, it reveals the number of times interest can be covered by operating profit. This is a solvency ratio. Remember, solvency is the availability of cash over the long term to meet maturing obligations such as interest. The higher the interest earned ratio, the better able the entity is to fulfill its interest obligations. From this description, we can get an idea about the formula of this ratio. Operating profit, or the profit before deducting the interest expense and income tax, divided by the interest expense. Even the name of the ratio gives us a clue of the formula. Times interest earned. The denominator is the interest expense, while the numerator is the earnings or profit, but not the net profit or the net income. Also not the gross profit or gross income, but the operating profit or earnings before interest expense and income tax. The income statement of Elizabeth Tailoring Materials Store shows interest expense during the year of 150,000. How about the operating profit or earnings before interest expense and income tax? We have two ways to compute for that. The first is the gross profit minus the operating expenses. So, 8,070,000 minus 3,800,000 and minus 2,500,000 equals 1,770,000 operating profit, which should be our numerator in the formula. The second way to compute for that 1,770,000 numerator is the net income of 1,620,000, then add back the income tax, although there is none in this income statement, and also add back the interest expense of 150,000. That would give us the same amount of 1,770,000 numerator. That's why it is known as profit before interest expense and income tax. We add back the interest expense and income tax to the net income. Before we proceed any further, let's make the computation of the numerator clear. Profit before interest expense and income tax. This means profit before deducting the interest expense and income tax. Because the net profit or net income is already after deducting the income tax and interest expense, to get this numerator, we have to add back the income tax and interest expense to the net profit or net income. That's why 1,620,000 net income plus 0 income tax. Then plus 150,000 interest expense equals 1,770,000. Then to get the times interest earned ratio, we have to divide it by the interest expense of 150,000. And that is equal to 11.8 or 11.8 times. The entity can well afford to pay its interest obligations, its operating profit being 11.8 times as much. Another important thing you should know is that aside from the interest expense and income tax, some financial analysts prefer to add back also other expenses which do not require cash payment or cash outlay, such as depreciation, depletion, and amortization expenses. They reason out that adding back also those non-cash expenses to the net income would result to the numerator becoming a better estimate of the amount of cash generated from operations which is available for the payment of interest expense. Moving forward, most likely you already know that entities often pledge their property, plant, and equipment as collateral to secure long-term loans. It is not surprising, therefore, that analysts compare a firm's plant assets net of their accumulated depreciation to long-term liabilities in order to evaluate its ability to obtain long-term financing on the strength of its asset base. The name and formula of this ratio obviously tell us how many times non-current liabilities can be paid out of the net plant assets. It suggests how well a firm manages its long-term debt. Hence, this is a solvency ratio. The entity which is the subject of our study has these four types of plant assets with total net amount of 15,430,000. It is necessary for me to point out that I box these property, plant, and equipment accounts, not this description of total non-current assets, to make it very clear that the asset classification property, plant, and equipment is not the same as non-current assets. Property, plant, and equipment is just one group of non-current assets. There are other non-current assets which are not property, plant, and equipment, such as long-term investments and intangible assets. Please be well aware of that, because I've seen articles from the internet confusing property, plant, and equipment with non-current assets. As you can see here, however, Elizabeth Tailoring Materials Store does not have other non-current assets aside from these fixed assets or property, plant, and equipment or plant assets. Therefore, this total non-current assets of 15,430,000 is also the total net amount of the plant assets. How about the company's total non-current liabilities? 1,200,000. Its plant assets to long-term liabilities, therefore, is 12.86 times, which is a good enough ratio. Just like other ratios, however, to be more meaningful, this ratio must be compared with that of previous periods and other entities. Aside from liquidity and solvency ratios, there are also financial ratios which are measures of profitability. The necessity of earning profit cannot be overemphasized. Without profit, it is impossible to attract creditors and investors. One profitability ratio is the profit margin on sales, which indicates the percentage of each dollar or peso of sales that results in profit. Please be well aware that the term profit margin here refers to the bottom line in the income statement, which is the net profit, not the gross profit nor the operating profit. In fact, profit margin on sales is also called net profit margin, net profit ratio, and net margin. Likewise, it is known by the name return on sales or simply profit margin or profit ratio, and even profit percentage. So many names referring to the same ratio. Just like how people call me by several names, aside from my real name and nickname, like handsome, good-looking, hot. Anyway, it will benefit you to keep in mind this early, that when we talk about financial ratios, every time you see the word return, it's net profit or net income that must come to your mind. Just like the other financial ratios we have already discussed, the name of this ratio gives us an idea about its formula. Net profit divided by net sales. As I just mentioned, the profit margin here refers to net profit, hence the numerator. As for the denominator, don't forget to use the net figure of the sales. For corporations with preference shares or preferred stock, instead of the net profit after deducting income tax, the numerator is the earnings or profit available for ordinary or common shareholders, which is actually the net profit after deducting the preference share dividends. For such corporations, these earnings available for ordinary or common shareholders is the bottom line in the income statement. As an aside, let me just point out that although dividends on preference shares are shown in the income statement, those dividends are not considered as expenses. Dividends are distributions of earnings or capital to the shareholders, not expenses. Anyway, so please remember that the profit or profit margin referred to in this ratio of profit margin on sales is always the profit after deducting all costs and expenses, including interest, taxes, and preferred share dividends or preference share dividends or preferred stock dividends, if any. No wonder this ratio is widely used as an entity's measure of the overall profitability of operations. For Elizabeth Materials Tailoring Store, the bottom line of its income statement is the net profit or net income amounting to 1,620,000. Its net sales figure, on the other hand, is 12,120,000. Hence, its profit margin on sales is 13.37%, which means that the net profit of the business is 13.37% of its net sales. Actually, we can also express our answer as 0.1337:1. and say that for every 1 peso of net sales, the entity earned net profit of about 13 centavos. To be more meaningful, this ratio for the year must be compared with that of previous years and with the ratio of competitors. Obviously, the higher this ratio, the more profitable the entity is. The nature of an entity's business should also be taken into consideration in determining the adequacy or inadequacy of the net profit ratio. A company which is engaged in a high-risk business or uses slow-moving assets that are costly to replace needs a very high net profit ratio. By the way, in case of net loss instead of net profit or net income, this ratio must appear with the negative sign. Also, in case you haven't realized yet, this profit margin on sales of 13.37% can be seen on the common size income statement of the business, which we did in the first part of this lecture series. Here. Because remember that in doing the vertical analysis on the income statement, each account or item here is expressed as a percentage of net sales. Hence, when we divided this net income of 1,620,000 by this net sales figure of 12,120,000, we got this 13.37%, which is the net profit ratio or profit margin on sales.